All right, so we're at section 4 or 5 in the advanced certification. And in this one, I just used summary pages. I didn't use any of the important boxes because it's quite lengthy. More than half of it is sales tax. So let's get started. Managing sales tax manually can be time-consuming and complicated. It requires setting up sales tax agency information, finding appropriate rates, which could be single or combined if local municipalities also have sales tax applied, and also staying on top of changes to tax rules, sales tax holidays, and rate change. Thankfully, QBO has set up the Sales Tax Center to do most of this for you. Once you input your business location, a sales tax agency can be selected by location, and then QBO applies the rates for both the state and local taxes. And then they do all updates automatically. This hybrid sales tax experience combines the benefits of automation with the flexibility to set up custom, single, or combined rates if needed. And most importantly, it tracks the sales tax liability according to how you have it set up. So you could say your liability has to be paid monthly, quarterly, and etc. So why would you need to enter a custom rate? Most clients use the automated sales tax. However, there may be times when you need to change the sales tax rate. I showed this in the QBO class I posted for the 10 chapter class. We wanted to use the tax rates in the textbook, so we had to override the tax rate by selecting the see the math. We will explore this further in another slide. A client may need to enter custom rates for items where sales tax do not apply, but other types would, like such as food and beverage tax or lodging tax. Right now, some states are waiving fuel tax to help with gas prices. I know New York City is one of them. So consumers are hopefully paying a little less if the state is waiving sales tax. So for that, the fuel tax for the gas stations, they don't have to pay that, and therefore they can lower their prices. Note, custom rates are not available in the Simple Start subscription. All right, so there's a page that they have out there. In the training section, you can click on the link. If I were to click on it, it would bring me right over here. And this is the Sales Tax and QuickBooks Online page. And if you go down, you'll see there's several frequently asked questions and links that you can click on there if you are looking into setting up sales tax for a client. So it has all you need to know about setting up and using sales tax. It's found in the training section, and like I said, it's a link that has several frequently asked questions. And again, you'd access it by going to the Pro Advisor and then training section. This is the advanced certification. So the Sales Tax Center is where you and your client can track the sales tax liability for each tax agency and show the totals for sales tax that is currently due, upcoming, and past due. In the Sales Tax Center, there's two tabs. You'll see Sales Tax and Payroll Tax. But it's under the Sales Tax tab that you'll see Sales Tax Due, and this is the total amount your client currently owes to tax agencies. Now under the Tax Breakdown area, this shows the sales tax that's due this month. So those are taxes that are currently due and require more immediate action. Upcoming, those are taxes that are being accrued for the following period. And overdue, those are taxes in which the due date has already passed, and obviously you are going to incur a late fee. Then there's also a link there, View Return. When it's time to file the return and pay the sales tax, you would select View Return link, and you would get the information you need to file your tax return. Typically, you will need to leave QBO and go to the agency's website by clicking on that link. That'll bring you eventually to there, and that's where you would pay your taxes and file your forms. After filing your taxes, you would then record the payment in QBO so that it could be marked as filed and moved to your client's history area. Record the payment in QBO by selecting View Return and then select Record Payment button. So here's some of the other sections you'll see there. History, here's where you can review any returns that were previously marked as paid and filed within QBO. Then you have sales tax settings. Here you can view and edit any any tax agencies set up within your client's QBO account, as well as add any new agencies So you would select and edit the button next to any tax agency to make it inactive. And then you have reports. You'll find quick links to the sales tax liability report and the taxable customer report. You can still find all other reports using the report tab on the left-hand navigation pane. And then you see shortcuts. Shortcuts means you're just a tap away from everything that feeds into sales tax calculations, like customer addresses, product services, lists, etc. So as you saw in the Pro Advisor section on sales forms, that is an invoice, sales receipt, or a credit memo, sales tax is automatically calculated based on the following factors: the customer that you're charging, so is it a governmental entity, is it a nonprofit organization, etc. What product or service the client is selling, what the tax agency set up in QBO is for a state to which the client is shipping, or for the sales tax status established, the time of sale, so that's when it's actually dated, because obviously if there's any update and starts on a specific date, it all depends on when the date of the invoice is, and then the address from which the customer is selling the products from. Certain organizations and business that meet specific criteria will be exempt from sales tax. These criteria are determined by each state, so you'll need to check with the relevant rules for the state that you're in. Some examples of tax-exempt customers are state, local, and federal government agencies, nonprofit organizations, resellers, providers of raw materials used to produce other goods like manufacturers. And QBO allows you to check the box, this customer is tax exempt, so that sales tax will not be calculated for that customer. You must give a reason for the exemption. And then here's where you find that. So this is when you go new customer, this customer information pop-up box comes, and then if you go down to the bottom, you'll see several tabs. One of them is tax info, and that's where you'd be able to select this customer is tax exempt, and then you would have to apply a reason. All right, for most products, the sales tax category would be taxable standard rate. You should always use this sales tax category if the product will ever be taxable. When would you select non-taxable? Generally, you're not required to collect sales tax for the following items: services rendered, wholesale purchases. So if your client is a reseller and they won't be paying sales tax on the purchase, instead you will charge they're going to charge their customer sales tax, and they don't pay sales tax. Goods that are being used as raw materials to make other products. If an item is not taxable, then choose non-taxable from the sales tax category drop-down menu, regardless of the location or customer. Remember, if the item will never be taxable, if the item will ever be taxable, you're going to mark it as taxable standard rate. But if it will never be, you would mark it as non-taxable. All right, what if a state has special sales tax rules for a particular product or service? Many states have special tax rules for services, software or digital goods, and telecommunication goods, especially when it comes to delivery methods of those items as well, medical devices and drugs, foods and beverages, and clothing. So if any special rules apply, then you would select choose a special category from the sales tax category dropdown. From there, you would choose the appropriate categories, subcategories, and individual selections. If no special rule applies, then you would just choose taxable standard rate. So when you set up a product or service for a client, you'll need to select the appropriate sales tax category as shown here. So if you see down here, they'll have a drop down into sales tax category, and the first one is taxable standard rate. Then there's non-taxable, and then what we just spoke about, choose a special category. Since QBO's automated sales tax feature calculates sales tax using tax agencies, not custom rates, it automatically tracks rate changes. What does this mean? So states sometimes change their sales tax rates, and once these changes become effective, QBO updates the sales tax rate immediately. effective of that date. QBO also tracks sales tax holidays, so certain states provide days that are free of sales tax, usually in accordance with a holiday, to encourage higher sales. An example would be back to school tax-free days. We have that out here in the Northeast sometimes, and this way parents get to save on school supplies, uniforms, etc. On these days, companies would not charge sales tax for that state for certain items, and QBO automatically takes these days into account. When you create an invoice for a client, QBO calculates the tax rate based on the seller's address, not the buyer's billing address. What if the client is shipping an item to a different address? If the shipping address has been entered, the sales tax will automatically be calculated on the shipping address unless you override it. When would you need to override it? Well, in some cases, the location of sale is different from the seller's address or the shipper's address. So, for example, a client might ship a product from a warehouse located at a different address than their main business address. In that case, you would choose to calculate the sales tax on the warehouse address instead of the business address. Do this by selecting Sales Tax Link and change the answer to No in response to the question, are you shipping this item? You can then change the location of sale fields, and that would be found over here. If you took my class, you would see we had to override because we didn't have a shipping address in one of them, ship to, and so it automatically put the companies. So sometimes you do have to override, or make sure you go through your client's customer and vendor fields and make sure they filled out everything properly. If the client is shipping to an address in a state for which there's no sales tax agency set up for QBO, an alert will appear at the bottom of the invoice. The alert will state that the agency is not set up and suggests you select the See the Mask link where you'll be able to set up the new sales tax agency. So let me just scroll down so you can see that. Okay, so this is what, whenever you get an alert, you have like this little yellow and an explanation point. When you are located in a state that has local taxes and you are shipping within that state, QBO calculates the correct sales tax rate depending on whether the state is an origin or destination state. States with origin-based rules, for these states, the origin of the transaction takes precedence in sales tax calculations. Sales tax is calculated and collected based on the locale, district, or county of the ship from address. States with destination-based rules, for these states, the destination of the transaction or the customer's address takes precedence. Sales tax is calculated and collected based on the locale, district, and county of the ship to address. The exception of all this is California, which employs a hybrid approach as follows. District and local taxes are calculated and collected based on the ship to location. County taxes are collected and calculated based on the ship from location. QBO assesses tax rates based on the company's address unless there is a shipping address, in which case the shipping address then would be used. In this case, it'll be based on the shipping address, and this is also a location shipping from field for clients that sell from multiple locations, such as multiple warehouses. So when you're using a custom rate, the sales tax is still calculated on the customer's tax status, as well as the product and service tax liability. Service taxability. However, the location and date of sale don't apply. You can specify that the customer is subject to a custom rate in the Tax Info tab of the Customer Information Record. That's where we looked at earlier. To add a custom sales tax rate, go to Taxes and then select the Sales Tax tab and then select Sales Tax Setting. In the Custom Rate section, select Add Rate. Select either single or combined. Combined, you would choose if there's a local municipality that you guys have to add to the sales tax rate. You can add a combined rate to group individual tax rates that are charged at the same time. By doing this, you don't have to select each rate when you add a new sale. All you need to do is select one combined rate, and QBO will calculate the total tax rate automatically. Enter the name of the custom rate. If you're adding a combined rate, enter a nickname for each individual tax rate you want to combine into one. Select the agency you filed payments to. If adding a combined rate, select the agency for each rate you need to group as one custom rate. Enter the rate, and finally select Save. Note that if you're using a custom sales tax rate, you're responsible for editing it in QBO to make any changes, because QBO will not automatically update those rates because they're custom. Setting up sales tax agencies. Clients sometimes need to track and pay taxes in multiple tax jurisdictions. It's easy to add a new tax agency to the client's agency list in the Sales Tax Center. Steps are listed below. So you would go to Sales Tax Center, select the Sales Tax Settings link on the right, and then select Add Agency. And from the Agency dropdown, select an agency. Select the filing frequency in the next dropdown. Remember, the filing frequency is determined by the state and is often based on the volume of sales. Check your state website for the correct frequency. Then you would set the start date, and then you select the reporting method, and then save. The new agency now appears on the list. If you don't need to collect sales tax for that agency anymore, you can always go to Edit and make them inactive. Adjusting the sales tax on an invoice. By default, QBO automatically adds sales tax to invoices for taxable items. However, you can always see the calculation was derived, so you can correct any errors or override the tax charge if needed. To do this, you would select the See the Math link. Remember, we did this for our QBO class I posted. In the first section, QBO shows you the customer is marked taxable. If they should be tax exempt, then you can just simply go to the pencil icon and check that box. The next section shows how the sales tax is calculated based on the address the client is shipping from or to. Select the pencil icon if you need to specify that they're not shipping the items. The last section shows the tax categories for the items on the invoice. If the tax category is incorrect, you can edit it by selecting the pencil icon. If no special category is applied, that default rate will automatically go to the shipping address, or the seller's address, or location of sale. It does not consider any special rules or exemption for that state. Here, select the Override the Amount link to enter your own calculations, and then you would select Close and Save. That's actually what we did in our example that I was saying in the book. So if you'd like to see that, you should go to that chapter. Offhand, I don't know what it is, but we did do that where we were overriding certain. We actually did it in a couple of chapters. Let's start by looking at how to override a sales tax calculation on an invoice where the sales tax is calculated based on location. Open the invoice you want to edit and look at the blue See the Math link. So that would be right over here at the bottom where right under your sales tax. It'll say See the Math if you want to get where the percentage is going, where to which state and agency is it going. This shows the calculations and rates used by QBO to generate the sales tax to be added. At the bottom of the drawer, you can manually override the sales tax charged by selecting Override this amount. So if you see here, there's going to be a blue link, and you'd go to Override. So this would be the third section down, and this is where you'd be able to manually override the percentage. Now, I had a client a couple of years ago that did this, and they didn't actually allocate it properly between the state and the local municipality. However, they did have the correct percentage. So as long as you have that correct percentage, you could always go back and add the percentages to the appropriate agencies, as long as you have the correct percentage. If you don't have the correct percentage, that is your liability to pay whatever the discrepancy is. The customer sales tax detail is a section where you would mark the customer as tax exempt if needed. You can also change the default sales tax rate. Then you have the client tax agency and standard rate. This section shows you which of the client's tax agencies and sales tax rate QBO is using to calculate for the total. And then you have the tax categories and totals at the bottom where they have that override this amount. And this is where you'd be able to edit the taxable status of the product and service listed on the invoice. If you have determined that the sales tax is applied incorrectly, then you can go to choose a special category. I think in the example we used, we always selected other, and we changed it manually. Selecting override this amount opens a pop-up screen that allows you to change the amount of sales tax charged. Qbo lists reasons why the sales tax might not be correct and gives you guidance on what to check. Depending on what you want to override the sales tax, you can adjust the sales tax by changing the rate, percentage, or amount. And you must enter a reason for the override before it can be recorded. You would use the drop down for this. So if you see they have other, tax rate is incorrect for my sale, this item isn't taxable, so they have several of them. I know in our example we used other. If your sales tax calculation is based on a custom rate, when you go to see the math, you'll only see one section, and that's customer tax details. This section pulls the customer's taxable status and their default tax rate from the customer record. Filing sales tax forms. So Qbo makes filing sales tax forms easy by giving you and your client the information they need to file the return and showing them how much is owed. Keep in mind that when your client files the tax forms at Qbo, it only records the amount to pay and updates the liability account. It does not actually make the payment for you or transfer any money anywhere. So you're actually going to have to file and make the payment on the state website yourself. Qbo is just for recording. Make sure that the sales tax filing basis matches the accounting method. So Qbo determines the client's sales tax liability based on the accounting method of accrual or cash. And that is what you selected in your accountant settings area. If your client's sales tax filing basis is different from their selected accounting method, you or they will need to change their accounting method when they're ready to file their tax return. And then just to make sure they have the correct liability amount. Remember to change the accounting method back after you're done. I think we revisit this at the end. And then that's where you would see it. Remember, you went to your accountant settings and then you would select whether you have accrual or a cash basis. Remember, doing this only records the amount and updates the liability account. You or your client will need to make any payments on the state website. So to do this, you would go to your Sales Tax Center and you would select View Return, and then you would select Review Your Sales Tax screen, and that gives you the information you need to file a return. It shows you your tax agency, the tax period, and the due date. To file a return, there would be a link there. You would select it, it would bring it to your tax agency website, and you'd fill out the return. Then there'll also be additional instructions under the link. The screen also displays the gross sales, non-taxable sales, taxable sales, and the tax amount due. If you need to adjust the sales tax for rounding or other situations, you would select the plus add an adjustment link. From this screen, there's also a link to view the tax liability report. Select Record Payment. Note that the amount is pre-filled and Qbo shows the steps to take in the filling process. Add the payment date. Select the source. That's your bank account information. This screen gives you the option again to download the payroll tax liability report and fill out the form at the tax agency website. To print the check, you would go to Check, and then you would select the Print Check box. Next, you would select Record Payment. A message appears to confirm that the return is marked paid. Select Back to the Sales Tax Center to leave the screen. To print the check, you would go to +New, then Print Checks. You would select the sales tax payment and enter starting check number, and then Review and Print, and then finally you'd select Print. So let's now look at the visual of this. So here is where you would see in your sales tax. See, this would be sales tax. I know it's really hard to see. And then the right tab is payroll tax. And then over here is where you would see that view return that you would click on. And we just spoke about how that starts the process. And then when you go to that, when you click on that, this appears. And then over here is where they have the plus add an adjustment link if there's any type of adjustment you need to make to the amount that QBO has there, and maybe there's a discrepancy on what your state, what you have to actually pay the state. Choosing the reason for an adjustment from the drop-down, there's several ones if you have to do the adjustment. So remember, we just did the plus add adjustment link. So here are our reasons. We could do credit discount, prior payment, prepayments, and prepayments, and then other, which include penalty, interests, and rounding, which can be posted to an income or expense account depending on if it's increasing or decreasing. So here it says choose an income account if it's reducing the sales tax, and choose an expense account if it's increasing the sales tax. Number 4, use the other fields to enter the following: the adjustment date, the account associated with this transaction. Remember, the type of account determines whether the adjustment will increase or decrease the sales tax, and the amount of the adjustment. Note that there's only positive numbers that could be accepted here. Only you make the adjustment. QBO updates the return and allows you to make additional adjustments. If you entered a payment in error, then you would select history from the sales tax center, and then you go to view the return next to the period that you want to delete, and then you would select the date link and then select delete. Select delete again on the confirmation screen. So this would be the pop-up and you would select delete again. The return from the sales tax payment will no longer appear in your sales tax history. Instead, it will move back to the sales tax due. Any adjustments made on the return will also be deleted. Adjusting sales tax. So sometimes you and your client will need to adjust, as we just said. This is where manual intervention is required. Examples of when you would need to adjust a sales tax liability include when the client state gives an early payment discount that needs to be recorded. So it's saying to you, well, if you pay within the first 15 days of the month, we will give you, let's say, 2% off. So you're showing this specific liability in QBO, but it should actually be discounted 2%. So you would note that in your adjustment that the reason is because you got a discount. Or if there was a penalty, so maybe you were late. Or when the use tax needs to be added. Or when you need to adjust up or down because your sales tax agency only accepts whole dollars, so you need to round up or down depending on the decimal change. Or when there's a prepayment that needs to be made. Which statement? Okay, so here we are at a summary. So these are the questions you may see. Which statement could you say about custom sales tax rates? So make sure you have this in your notes because this is our summary pages. So which statement can you say about custom rates? You can use custom rates to track other types of sales taxes. Here's another question. Your client needs to track a specialized tax even though they don't need to charge sales tax. They wonder if there's a way to track it in QBO using the hybrid sales tax experience. What do you suggest they do? Add a custom rate and assign it to the appropriate taxing agency. Here's another question. Your client sells a taxable item and ships it to a customer that's out of state. There's no sales tax agency set for that state. What sales tax rate would QBO apply? No rate. So QBO would not apply a rate because, according to them, that state does not have to pay sales tax. How does QBO know to which customers a custom sales tax rate should apply? It would be identified in the Tax Info tab of the Customer Information Record. Which two statements are correct regarding adjusting sales tax on a return? Early payment discount credit should be posted to an income account, and rounding down should be posted to an income account. What are two reasons you might need to adjust sales tax? You okay? How does QuickBooks Online know to which customers a custom sales tax rate should apply? Oh, I'm sorry, I did that one already. I'm over here. What are 2 reasons you might need to adjust sales tax on a return? To add a penalty for a late payment or to add use tax? Where in QBO do you indicate that sales tax returns will be filed on a quarterly basis? You'd go to the sales tax setting, you would select agency name, edit, and then filing frequency. A client has contacted you because they're expanding their services to additional states. Their services are not taxable in the client's home state, but neighboring states do require sales tax to be accessed. Because the services are sometimes taxable, you mark the item taxable in the item setup. Which 2 accounts do you need to take to ensure sales tax is calculated correctly for these services? You want to identify which customers the sales tax for these services should apply to, and you want to choose the appropriate special category when setting up the taxability of an item. You have been informed that your state tax rate is increasing on July 1st, and it is set up as a custom rate in QBO. Which statement is true? It will need to be manually changed. Because remember, when you set up a custom rate, QBO will not automatically. They only do that for the automation ones. If you think sales tax is not being calculated correctly, which 2 of these should you verify? 1, that the correct tax category is selected, and 2, that the tax is calculated on the correct address. Where did you set up a new sales tax agency? Where would you set up a new sales tax agency? You would go to the Sales Tax Center, Sales Tax Setting, and then Add Agency. Which 2 statements are true about filing sales tax returns? You can see the tax period and due date on the Review Your Sales Tax screen, and QBO will give you a link to the state's website to file and pay. You see there's a lot of questions. And this is the last page on this. When creating an invoice, what is the importance of the location of sale fields in the header? The address in the field determines which sales tax should be applied when based on location of sale. When creating an invoice, where can you easily change the tax rate for a product? You'd go to See the Math and then the Tax Category section. And the last one, which 2 types of changes can be made when you select the See the Math on an invoice when tax is based on location? Mark the customer tax exempt and override the currently calculated sales tax. Those are the 2 types of changes. Mark the customer tax exempt and override the currently calculated sales tax. So that's it for sales tax. That was the big section. All right, using reoccurring transaction. And just as a side note, by the way, that noise and that interruption, I apologize for that. That was my son. He's taking a nap and he, by mistake, rolled off the bed. All right, more than 3/4 of most clients' transactions are repeated month after month, but clients usually can't spare the time to manually check, add, or categorize these regular transactions. In many cases, rules can help clients customize and automate data from bank feeds. However, there's a better way to invoice customers regularly for standard items and prices. There's the Qbo Recurring Transaction feature, and it makes it easier to create and save templates that have the information for transactions that happen on a regular basis. Clients can create reoccurring transactions to manage most transactions in any workflow, including sales receipts, invoices, bills, journal entries, checks, deposits, or expenses. So here we have a list. So the reoccurring transaction feature in QBO currently is used for the first transactions in most workflows. I just named them. In other words, See, step 1 would be creating your invoice. Step 2 would be payment received. So payment received is not one that you can use, but you can use invoice. So the following are the ones that you can create recurring transaction templates for. So you want to get these down in your notes. All right, some of the benefits to clients of using recurring transactions are automate money out transactions that are paid at regular intervals and fixed amounts such as rent or insurance payments. Automatically invoicing customers for regular services provided at fixed prices. Including unbilled charges and automatically sending emails when setting up an invoice for a recurring transaction. Set up recurring sales receipt with payments if they provide a subscription service or products such as regular cleaning or lawn care service. To record non-posting transactions such as a purchase order or estimate. For clients with Qbo or QB payments, you can create scheduled recurring invoices that are automatically emailed and enable customers to set up auto pay to automatically settle their regular invoices. And then recurring transactions can help you too. As a pro advisor, you could set up recurring journal entries to reclassify deferred revenue or prepaid expenses. There are 3 template types for recurring transactions. So here's an example of us setting up a recurring expense. And under the type, you have scheduled, reminder, and unscheduled. So scheduled. Scheduled templates automatically create a transaction at a set frequency or on set dates. Here are a couple of examples of when you or your client might use this. If your client uses QB payments and they charge a customer the same amount on a regular basis, such as every month or every quarter, they can create a sales receipt template for this customer and make it scheduled. The credit card or ACH information for the customer will already have been entered, so the sales receipt serves 2 purposes. It charges the customer's bank or credit card information, and then the client can set it to get sent out to the customer automatically as a receipt. If the client has QB payments and uses the scheduled template type to create a recurring invoice, their customers will have the option to enable auto pay from the invoice they received through the email. With auto pay enabled, Qbo takes care of all future payments related to this recurring invoice for the customer. If the client doesn't have a customer payment information set up, or if they're not using QuickBooks payments, they can create a template to set up an invoice to be sent to the customer regularly. Now the reminder. The reminder template is a hybrid that combines features of the unscheduled and the scheduled templates. When using the reminder template type, the transaction is ready to be created as per the frequency and dates. However, instead, Qbo creating the transaction automatically, and it reminds the client to review it and make changes before finalizing and sending it out. So your client would need to keep their eye out on the Qbo dashboard for reminder alerts. You can see here they would have it, and then you click View Reminders. The client can select the alert to see reminders that are due to be skipped, paused, entered, edited, or sent. One example of when a reminder template would be ideal would be for a client who regularly invoices a customer, but the details like the text, the amount, or both can change from period to period. The next one's unscheduled. The unscheduled template just sits on the list of recurring transactions to record transaction for future dates. Here are some examples of when you or your client might use an unscheduled recurring transaction template. So I just kind of copied the table, and I'll leave it up here for you to take maybe a picture or to be able to pause your screen to take notes. So you have daily sales Z-tapes, pre-populated detailed estimated templates, monthly journal entries that are very complex, or invoices that could be used for multiple customers at different times. All right, recurring transaction versus bank rules. A client can use recurring transactions to enter routine expenses like rent payments or utility bills. However, they're usually better off using bank rules instead because they take variations in dollar amounts and dates into account. This is easier than fixing amounts and dates or scheduling recurring transactions or looking for reminder transactions and editing them. If your client uses both recurring transactions and rules for the same transaction, then they must remember to delete the duplicate resulting from the recurring transaction. When would using a recurring transaction be a better choice? Well, here's a couple of situations where clients should use the recurring transaction instead of bank rules. If they wanted to create reminders to invoice a customer regularly, but for varying items, amounts, or descriptions. Note, if the item, amount, or description doesn't vary, using a scheduled recurring transaction, use a scheduled recurring transaction instead. Just make sure that the recurring invoice is set up with the automatically send emails checked. Recurring invoices can also be set up to include any unbilled charges to the customer or sub-customer or project. This is a feature that bank rule does not offer. If the transaction is for the same dollar amount using the same interval, that would be great for recurring. And the last one, or the last thing, however, use a rule if the dollar amount varies. So for example, cell phone bills, they could vary every month, and you would then use a bank rule. A client operates a food truck and uses a cash register to record their sales. They want to set up a recurring transaction to record the daily sales. What is the first step they need to take? First, they would create their sales receipt and save it as recurring. Your client would pay you for bookkeeping once a month, let's say for a flat rate. You're using QB Payments, and they provided you with their credit card information. What is the most efficient method of using recurring to get paid? Well, I'm in the summary, I see. Okay, so these are the questions. I apologize. So this is the question. A client operates a food truck and uses a cash register to record their sales. What would they do? They would create a sales receipt and save it as recurring. That's the answer. Question number 2, your client, hires you as a bookkeeper and pays you a monthly flat rate. What would you want to create? The answer would be create a scheduled recurring invoice template. Question number 3, for a company, the annual depreciation equates to $24,000 each year. In order for quarterly figures to show consistently, which 2 methods would you use? Or which 2 methods would work? One method would be to create a scheduled journal entry to record a monthly interval of $2,000 a month. 12 months, 2,000, comes out to 24. The other one would be create a journal entry selecting every 3 months, because remember it's daily, weekly, monthly, so you'd have to do every 3 months instead of quarterly from the interval options, and that would be at 6,000 on each entry. So I hope that makes sense. 2,000 a month or 6,000 every 3 months, and this would be a journal entry. And the 4th question, when would you schedule recurring transaction? When would a scheduled recurring transaction be the best automation option? When invoices are sent monthly to a customer for fixed amounts and descriptions, and for any unbilled charges as well. Because remember, we were saying unbilled charges does not apply to bank rules. All right, so those are the questions for recurring transactions. Now we move on to daily sales summary. So clients might not always want or even be able to enter individual sales transactions for each of their customers. So for example, a restaurant owner uses the point of sale system and isn't compatible with QBO and would need to manually record all of the individual transaction details. And that could be really time consuming. So instead, they'd probably want to do one big entry. And the daily sales summaries. Sales summary transactions allow clients to record a daily, weekly, or monthly summary of sales through a third-party system. And so that could be cash register, app, or shopping cart. And in most cases, the third-party system tracks transaction details, so clients don't need to capture them in QBO. A sales summary only records the information necessary to generate accurate financial reports and manage sales tax. A sales tax summary is a $0 sales receipt that records total sales for the day and matching funds in your QBO using a single form. It's like a point of sale end of day report or a cash register Z-tape. So I don't know how many of you have ever maybe worked at a restaurant and at the end of the day, you push a couple buttons and then bam, that's that cash register Z-tape comes up and it tells you all the information you need to know on what the sales were that day and what your money should be in your register. This is also valuable for businesses that don't usually track perpetual inventory, such as restaurants or other food service companies. These businesses often use the periodic inventory system, in which there's no need to track inventory details. Clients can also use sales summaries when they don't invoice customers, so they're only using cash. And then cash, also is checks, credit cards. In most cases, clients will want to record sales transactions daily, so let's look at daily sales summaries. So how do daily sales summaries work? In this $0 sales receipt type, the sales amount are recorded as positive numbers using service items mapped to income accounts. The collected funds are recorded for each payment method using a service item map to undeposited funds or bank accounts. So the payment methods would be check or credit card. They're mapped to undeposited funds or directly to a bank account if you didn't use that method. The amounts entered for these are negative. So our sales for the day are positive, our revenue, and then our payments are negative, and then it comes out to 0. And that's how we would record our daily sales summary. How do you set up a daily sales summary? Before your client can create a daily sales summary, you or they need to set up the following: the service items for types of sales that will be corresponding to the sales lines in the Z-tape report. So for example, the Z-tape report may have 2 sales lines, taxable sales and non-taxable sales. Another client might have food, beverages. Map these items to appropriate general ledger accounts, adding accounts if necessary. Then you can look at the payment methods. Clients can then create a daily sales template to record total daily sales every time they need to. They can create a sales receipt to record their total daily sales and deposit their total daily monies received when it clears. Let's look at how they could set up product service items for this process. Below are the steps on how to set up the service type items used for the sales amount on a sales summary. So you'd go to Sales from your left-hand navigation pane and select Product and Services. Select New and then go to Service. Enter the name for that service, and then that would be non-taxable sales. If the row of the daily sales receipt template represents total non-taxable sales for the day according to the Z, because remember we said earlier, most states the service is non-taxable. You would enter a description to represent the non-taxable sales that align with the Z-tape format, and you would leave sales, price, and rate field empty. You would select an option from the sales tax category dropdown, and in this case, it'd be non-taxable because it's a service item. And then you would select Save or Save and New to continue and create another service item if needed. To complete the setup, you or your client would need to create 3 items. 1, service items that represent the type of payments accepted. Any other items on the Z-tape that need to be included on the sales receipt. And a generic customer that you would use. I personally use cash sales. If you took my class with me, you would see I set up cash sales. Your client needs to find out which payment methods are accepted. They can get these from the line items in the Z-tape. They should also decide how they want funds deposited into their bank. They can have daily deposits, deposits made every few days, and etc. To determine the service items to be set up and the appropriate account mapping. For example, your client should probably use undeposited funds as their income account. If they deposit cash and checks from multiple days, separated. Undeposited funds will be increased each time the items are used as the sales summary transaction is recorded and will be decreased when used on the deposit transaction. Here are a few examples of the service items for payment methods that clients need to set up. You might have cash, checks, Visa, MasterCard, American Express, or gift cards. These may require additional setup of gift card liability accounts if you do use gift cards. Most point-of-sale Z-tape reports contain line items such as cash payout of drawer, which the client might need to set up. This may also need to be set up. A rounding item to account for differences in sales tax calculated for the total daily sales versus individual sales. 2 other items based on the client's workflows, such as gift certificates or prepayments. You would have to code that to a liability account. 3, any cash register overage or shortages, and you would code that to your expense account. And the last one is payout. What if the client wants to replicate many items from the Z tape on a daily sales summary? In this case, they can organize these items by creating a daily sales category in the product and service list, adding the relevant items to that category. Although clients don't need to enter a customer name on the sales receipt, it's best practice. The customer's name could be daily sales or monthly sales. You know, I said I use cash sales. To easily find sales receipts that record all daily sales summaries, set up a bank account type called Sales Summary Register. Use this as a deposit to account on these sales receipts. While the Sales Summary Register is really a type of clearing account, using it only to $0 daily sales summaries, it will provide a register that lists all the transactions that you recorded under that. As with any other clearing account, remember your balance should always be 0 at the end. After you set up the basics, you could create a daily sales template to record total daily sales. To do that, you'd go to the gear icon, Reoccurring Transactions. You would select New, and you would select the sales receipt. And then a pop-up would come up. You're going to select OK. You're going to give the template a name. Then you would select an option in the type drop-down. In this case, it would be Unscheduled. If there's a customer to represent daily sales, you would choose that. Remember, I said cash sales, so you would select that customer's name. And then from the deposit to drop-down, you would select whatever clearing account you set up. And in the product service column, you would enter the income items first. To help with future entries, indicate in the description column whether the item is positive or negative, or if it's taxable. We talked about earlier which ones are positive and which ones are negative. If the item is taxable, make sure to check the box in the tax column and select the correct sales tax rate from the bottom of the screen. Leave the amount column empty. Next, enter the payment items in the product service column. As with the income items, add a note to the description and indicate that they are going to be negative. Leave the amount column empty. Add other payment items such as cash payout of the drawer as necessary for customers. Remember to follow the lines on the Z-tape. Make the product service in the last line cash over short items and add a description. The value of this line can either be positive or negative depending on whether you were short or over for that day. Then make sure you have your appropriate sales taxes, payments, and other items. When done, save that template. Once the sales tax template is set up, your client can start recording their end-of-day sales. To do this, they would find their sales receipt template in the Reoccurring Transaction list, and they would go down to the right and click the Use, the little blue link. You would enter the date and the dollar amounts from your Z-tape and other third-party reports. So if you're using your Z-tapes, you should see it exactly set up like your Z-tape is, or if you're using a third party as the apps I called out earlier, you would use that one. The sales tax total should equal 0 at the end, because remember the negative and positive should. If it doesn't, then that's where you use that over shortage, right? Because the cash over shortage is what would allow you to get that to 0. Clients activate the sales tax center to track sales tax owed by marking an income item as taxable. However, they might also have to set up a rounding item because the sum of the individual sales multiplied by the sales tax rate might not exactly equal the total sales times the sales tax rate. Alternatively, if clients don't want to use QBO's built-in sales tax feature, they could set up service items to record sales tax to match the Z-tape amount exactly. They need to set up a separate sales tax payable account for each taxing jurisdiction or sales tax agency on the chart of accounts. If they use service items to track sales tax collected or payable, they should enter the sales tax amount as positive on the sales receipt. They will show you a table of daily sales displayed, then may ask, when setting up the retail sales, taxable product service item, income account fields, which account should be selected? So here's our daily sales summary, right? So these are the questions you'll see on the test on this topic. So they will show you a table. What I'm saying here is on the test, they'll show you a table of a company's Z-tape, let's say, telling you, the items that they sell and the methods of payment. And then they might ask you, when setting up the retail sales taxable product service item, what would be the income account for that particular item? And the answer would be sales of product income. So what they're asking here is for your retail item, for what you're selling, your product. And you should know this, and we did this in the class that we did. So if you set up a product, the income field would be sales of product income. Now this second question also goes up to this. So if there was a Z sale tape, right, and they ask you, when setting up the check or cash or any payment source item, so if they said check item, so when setting up a check item, what would be the income account? And in that case, for the payment, it should be undeposited funds. I hope that makes sense. Which statements are true about using a daily sales summary in QBO? The transaction is a $0 sales receipt. And another statement is the transaction is a sales receipt that deposits into a clearing account. Oh, that was it. All right. I think we're like 2/3 through now. Next is $0 transactions. The principle of a $0 transaction is straightforward. You create a transaction in which the total of the positive lines and negative lines enters equals 0. You could do this for pretty much any transaction type, such as using $0 sales receipts to record daily sales. This is covered in the daily sales summary lesson we just looked at. To illustrate how $0 transactions work, let's look at one type. Let's look at the $0 expense. In this transaction, you have a debit part and a credit part, and they offset each other. So we debited accounts payable, and then we credited accounts receivable, and it came out to 0. If you have a class, a job, a location, and the tracking is turned on, you can also allocate the expense to any of those. To do this in the allocation component of the entry, which is usually the debit part, you would then put in your debit part. Oh, this is from the training, actually. You would put whatever these are classes. You would put them in there in the debit, and then you would probably credit whatever the expense is to get that 0. The client should set up a clearing account to record these types of adjustments. That way, the $0 transaction does not appear in the register or reconciliation screen of your regular bank account. And you have a central place where you can find the $0 transaction adjustments. Also, users who see $0 transactions in the regular bank account won't be tempted to delete them. $0 expenses are a good way for clients to allocate overhead expenses to classes or to allocate job costs, even if they're not billable. They allow you to round up many previously entered expenses and mark the total as billable, rather than editing countless original expense entries. $0 expenses can also be allocated to a customer or sub-customer, a job or project, or even a class or location. The first example they use in the training session is a business owner who takes a draw, but not a paycheck. So if you don't know draw, we're talking about withdrawals, owner's withdrawals. The business uses QBO basic time tracking, and the owner has been set up as an employee even though they don't get an actual paycheck. This allows the owner to track their time to particular jobs. You or the client can mark this time as billable or not, depending on whether the customer will be invoiced for the owner's time. You start by creating an account. Then we're going to create in this example a cost of good account. So if you see cost of goods sold is here, and then the detail type is also cost of labor, and then the actual name is labor owner's allocation. So this is what we set up in this example, owner's allocation. So you would create a service item as follows. You'd call the items owner's time. If your client is not going to invoice the customer for the time, uncheck the box, I sell this product service to my customer. If they are invoicing for the time, then keep the box checked. Then you enter a sales description, a sales price for the amount your client wants to charge. If the customer is going to be required to be billed, you want to put the daily, probably the hourly rate there. You want to select or set up the account where you or your customer wants the income to post to. Make sure to check the box, I purchased this product service from a vendor, and enter a description. Enter the cost. Use an amount equivalent to the hourly rate. For the expense account, you would choose labor, owner's allocation, and then you go save and close. Now you or your client can start tracking the owner's time. Remember, if they're not invoicing for time, then you would need to not check or uncheck the box where it says, I sell this product service to my customer. Make sure to report on the time the owner spent on various jobs on a regular basis. Once a week, twice a month, or whatever works for allocating the value of the owner's time to jobs. Let's say that the number of hours during the reporting period is 10. And the cost of those hours, $40 an hour. Now your client can use the data to create a $0 expense transaction as follows. So you would start by opening up an expense transaction, enter the owner's name as the payee, use the item detail grid to allocate 10 hours at $40 an hour, and that would go to owner's time in the service item. Remember that this is a service item and there has to be mapped to the labor, which is already mapped to your labor owner's allocation account when we did the setup. You would specify the customer or sub-customer and whether it's billable. Then you would use the category detail grid to zero out the labor owner's allocation account by entering in a negative number without specifying a customer. Once it is confirmed that the total transaction amount comes out to 0, you can see 0 on the top right, then you would select Save and Close. And this is what it would look like. So we have the category, and that's where we have our labor here, and we put the amount as 400. And then down here on the item detail, we put the owner's time, and we put a negative. It came out to 0. But this, I guess, is not, so they didn't put a customer or billable. So this example is not customer. So you wouldn't be adding the customer and selecting billable for this particular example. The transaction journal behind the scenes shows a net of 0 to the labor owner's allocation account. Now that the row debiting that account has the customer, sub-customer name, while the row crediting has no customer or sub-customer name. So you see that, I don't know if you can see it here, but it's in the training section as well. And a one-day profit and loss will indicate the net effect on the labor and owner's allocation account is actually 0. So you didn't actually do anything, we zeroed it out. We only just allocated the cost to the customer. You can also allocate a $0 transaction to a customer job or even a class or location. In the training section, they have you zeroing out to Craig's Landscaping. Remember that test drive? And they use it to allocate a job expense to Craig's classes. So Craig buys 58 bags of soil at $5 a bag in bulk before he knows exactly which customers he's going to be using them for and has to bill. So since he's used 25 bags on jobs of residential customers and 33 bags on commercial customers, he then would need to allocate those job expenses to those residential and customer accounts using a $0 expense. So first you need to make sure that class tracking is turned on. Once class tracking is on, then you can create these new two classes. So the two classes are going to be residential and commercial. So next you're going to create the $0 transaction as follows. So you're going to go to plus sign new, and then you're going to go to expense. You're going to choose the clearing account as the payment account. And in the items detail, you would put your class, and they would be followed by a negative sign. And then in your you would have your expense, which you should already have it allocated to the item, right? So you know exactly what you have 25 bags to residential and 33 bags to commercial. I think that was that example that I showed you earlier. That's what that was. The negative, the $0 expense for this example. Do I have? No, I don't. It's before. If you look a couple of screens before, I actually had it. What if your client owes money to a vendor, but the vendor is also a customer that owes the client money? So this is that AR/AP example. In this case, the two amounts owed will appear in the unpaid bills report for payables and the open invoices report for receivables. How can the client resolve this with a $0 transaction? In the example shown in training, they have Esther's Bird Sanctuary, which we know is from Craig's, owes Craig $2,739. However, Craig owes Esther $2,000. So note that the Bird Sanctuary has been set up with a slightly different name on the customer and vendors list. I didn't notice that, but okay. So Esther's Bird Sanctuary owes actually Craig $739 when you take the difference of those two. Processing this one payment is much easier than making payments back and forth. Craig can handle this as an expense transaction from a clearing account or a special $0 balance barter account and use it to net out the AR/AP as follows. So as a result of this entry, both AR and AP will be reduced by $2,000. Oh, they didn't even go over it, but that was the one that I had earlier, where they debited and credited the $2,000, and then we would have the difference of $739, which Esther would have to pay. What if a client uses a third-party payroll service and needs to allocate payroll expenses to various customers, jobs, or projects after the fact? So let's say a client's payroll expense for last month was $15,000, and you need to allocate that $15,000 to 3 different jobs. So you would create a service item with only purchasing information linked to the expense account called payroll expenses. You would create a $0 expense and use a clearing account. You would allocate the $15,000 to the relevant jobs. So you would list the 3 jobs, and then you would have a negative. So I don't know how the outcome would come. I think I have it on the next screen though, actually. But the zeroing out would be because you're going to put a negative $15,000 to payroll expenses. So let's look at it. Here it is. I don't know if you could see it here, but so there's payroll expense of $5,000, and if you had to put this to a specific location, you would select what the location is here. So this one is for locations. So that you're putting your different locations here and allocating the specific expense to that location. And then that last line is that total of these three numbers, which is 15,000, and would go under negative and would go to your payroll expenses. And in this way, under the journal entry, you really would have zero. You'd be zeroing it out. Okay, so here's owner's contribution examples. When the owner of a company starts a new business, they might want to pay for certain expenses personally. These expenses need to be recorded. If the owner isn't going to be reimbursed for these expenses, you or your client can use a $0 expense to record the transaction. So you would do that as follows. You would enter vendor name in the payee field. You would enter your clearing account in the payment account. You would enter the payment date, and then you would enter the expense account and the payment amount. And that would be under the category details, or under the item details if it applied. And then you'd fill in the other columns as needed. Now you would enter owner's contribution as the equity account on the next line, and you would make it negative. So you put owner's comp. So whatever it is, you'd have your positive expense, and the next one would be negative owner's contribution, and then that would zero it out, and it would put it into the owner's contribution into the business. So in this example, it was contractors. So they had the contractor expense, and it was for $2,500, and then right under that you would have owner's contribution, as you see here, and then you would have a negative for that same amount, giving you a total of zero. You would see that, okay, the balance of this is zero for the expense. A client is setting up a business, but he or she hasn't set up the business bank account yet. So here are $0 transaction summary questions. But they need to record a business expense paid personally as a contribution to the business. How could they do this? The answer would be by using a $0 expense, entering the vendor name as the payee field, entering the amount in the expense account as a positive, and the owner's contribution as a negative. We just literally looked at that. Here's another question. A client needs to allocate utilities to different funds that are set up as classes. They also have to set up a class name to be allocated. How do you recommend they allocate the utilities? By posting the expenditures to the utility expense and the to be allocated class. At the month's end, they should use a $0 expense and allocate total utilities for the month to the funds as a positive number, and to the to be allocated class as a negative number using the utilities account. Here's another question. 6 months ago, a client purchased various types of products in bulk and expensed them. The business is partway through the completing of multiple projects and has calculated that $1,200 of those materials have been used. The cost is to be split evenly among 3 jobs and recharged to the customer. How can this be done? The answer would be create a $0 expense. On the first line, enter a negative value of $1,200, followed by 3 positive expense lines of $400, each associated with a customer and marked as billable. Clients may sometimes receive payments that bounce due to insufficient funds on the customer side. If that happens, the client may also get charged a penalty fee by their bank. In these cases, you and your client need to make an adjustment in QBO to record the failed payment and any bank charge incurred. If the payment fails, your client needs to record the deduction of the return check and bank fee in their bank account, increase or debit the account's receivable balance for the amount that was a failed payment, and decrease or credit the cash for the same amount because it didn't make your bank account. Then you would need to record the bank fee, invoice the customer for the bank charge plus any handling fee, restore aging of the original invoice because the payment still needs to be made. Below are the steps to record the failed payment. So first we need to create a service item for the check itself and charge from the bank. So you're going to go to Sales, And in the product and service list, you're going to go to New and then go to Service, and you're going to name it Bounced Check. In the income account, you would select Checking, and you would map it to your checking account. In the sales tax category, you're going to select Non-Taxable, and you're going to go Save and Close. Name the next service item Bounced Check Fee. Map it to Bank Charges Expense. And in the Sales Price Rate box, add the fee that the bank charged for the bounce check. If the fee varies, we'll leave it empty. Usually most banks have a set fee, like $35 or something. Note that if your client is charging more than the bank charges them, they may want to set up a bounced check fee income account. So what they're saying here is, I got a check and it bounced. My bank charges me $35. I'm going to charge my customer $45 for that $10. I need to put that into my bank check fees income account. This is also non-taxable. So select it from the sales tax category dropdown and then save and close. Then create an invoice for the customer that includes the amount of the bounce check and the bounce check fee. To do that, you would create an invoice, fill in the invoices needed. In the product service column, add bounced check and the amount of the check. And on the next line, bounce check fee and the amount that the bank charged. And then select Save. Now let's create a new expense transaction for the bounced check fee. So you're going to go to +sign New and Expense. You're going to put the payment date. Under category column, you would go Bank Charges Expense. You fill in the rest of the details and save and close. And the last step is you need to reset the aging on the original invoice because they still owe you that money. So you're going to go to Customer tab in the Sales Center. Find the bounced payment by selecting the customer first, and then go to the right invoice. Deselect the invoice as paid so that it can then be reinstated, excluding any fee charge on the new invoice. Make sure that the amount of the payment is unchanged, and then next select Save and Close. So here are our bounced check and insufficient funds summary. So here's our questions. How do you record the withdrawal of an individual bank fee associated with the bounce check? The answer would be create an expense categorized to bank charges expense account. Next question. A customer made a payment by check in the amount of $365.33. The bank indicated that the check was returned for insufficient funds. They're charging you $35. Based on the training, what is the first step that would need to be taken? The answer is create a service item for the check itself and the charge from the bank named bounce check fee. Last question. Once a month, a client processes all of the customer's direct deposit payments in one batch. A client's payment has been returned stating the customer's account has been closed. What is the first thing that needs to be done to record this transaction? Create two service items, one for the payment and one for the bank fee. So really question 2 and 3 have the same answer, just worded differently. And one was bounce check, one was a closed account. All right, next one is customer prepayment and deposits. Many banks ask for deposits before committing to major pieces of work or contracts to supply services. Many businesses ask for deposits before committing to any large contracts. Businesses like to have a simple way to record these upfront payments. Upfront payments like these are also called retainers, deposits, down payments, and other terms. But in training section of QBO, they use the term retainer. So we're going to use the term retainer. Clients can record retainers and then use them against future purchases. QBO offers 3 ways to record retainers. To determine which method is best for a particular case, consider the following factors. Whether financial statements are needed, for example, for investors, how often the client receives retainers and how much they are, how much time will pass between receiving the deposit and the work being done or product delivered, and the total value of combined deposits at year end. So the first one we're going to look at is a deposit feature. So we just do a quick overview and then we look at it a little bit more in depth. So the direct deposit feature in QBO allows clients to enter deposit in the invoice. The body of the invoice lists the goods or services to be sold, and the deposit received is subtracted from it. This means the revenue is posted as of the date of the invoice, even though there's likely hasn't been any exchange of goods or services. Note that this method doesn't conform to the GAAP because it doesn't use an unearned income liability account. When should clients use this method? This method is best used when you're only receiving retainers occasionally. They can also use this method if there's a short time between the receipt of the deposit and when the goods or services are performed. So I have the arrow all the way down here. Let me scroll down so you can see where that deposit now would be shown on your invoice when you set this up. The next one is credit accounts receivable. So clients can use the receive payment screen to enter a deposit without applying it to an invoice, because the related invoice has not yet been created. So the result is a negative accounts receivable balance. Note, ensure that your client's date doesn't require sales tax to be collected on the retainer. When should clients use this method? This option may work with small businesses that only use reports for management purposes rather than sending them to third parties, or when total retainers are negligible. It might also be the easiest method for clients who enter their transactions rather than having their accountant or bookkeeper do it. However, be aware that this method doesn't conform to the GAAP, just like the other one, because it doesn't involve an unearned income liability account. I'm starting to slur. It's 2 o'clock in the morning. We're getting there. This method tracks retainers through a customer deposit or client retainers on earned income liability account. This is unearned income method. When should clients use this method, the unearned income method? This option is recommended for clients who need to provide financial statements to outside parties like investors, or for whom retainers are normal courses of business or a material amount. This method especially suits clients with large deposits held for extended periods of time, months or maybe even years, cutting across several financial reporting periods. So let's look at recording the first one, deposit feature. How to record a retainer using the deposit feature. Start by turning deposit feature on. To do this, you'd go to your gear icon, account and settings, and then go to the sales tab. And then in the sales form content section, you would then enable it. And editing, you'd go to the little pencil icon and enable editing, and then you would use the deposit slider to turn the feature on. And then select Save and Done. This adds a deposit field to the invoices so your clients can subtract a customer deposit from the total to calculate the balance due. Now, using this method, you would then create your invoice. Note that the invoice now would have a deposit field between the total and balance due amounts. Populate the invoice with the necessary information, as we already know how to do. In the deposit field, enter the amount that was left as a deposit from your customer. QBO calculates how much needs to be invoiced, taking into account the deposit and any tax, if applicable. When a deposit is added to an invoice, QBO adds a deposit to drop down above the product service grid, and you would then choose undeposited funds, and you would click Save. To see the details of the transaction, you can go down at the bottom, click More, and then the Transaction Journal. And then there you would see the income is recorded based on the product and services entered on the grid of the invoice, and the retainer is posted to the undeposited funds. Any remaining balances then goes to accounts receivable. Now recording our credit to accounts receivable method. How to record this? With this method, it's best to turn off the automatically apply credit option so the credit applied are not sent to the wrong invoice. The first step is to record the retainer via a received payment you're going to creating a credit to the customer's account. In other words, a negative amount in the accounts receivable. So you're going to go to plus sign new, you're going to go to receive payment, you're going to select the customer, and then note that QBO shows an alert right away because they might not have an open invoice. You would enter the details of the retainer, and then you would select save and close. Because there's no invoice selected, a pop-up window will automatically come up, warning you, and then you would just confirm that that's what you want to do and save as credit. Is there anything else in there? No. All right. This retainer is now recorded, okay? And how would we apply the retainer to an invoice? When we're ready to create the invoice, we'd go to Invoice, populate the invoice with all the necessary details, select Save, and then once we finally get the payment, we would select Receive Payment, and then you would see in the amount fields, it would be 0 once they make, the final payment, and you would click Save and Close because the retainer would automatically be applied. At period end, create a journal entry to reclassify the credit balance from retainers for account receivables to an unearned income liability account. So what happens is, let's say we're at the end of the year and we have a few retainers that are still open. You would need to create a journal entry. So that's how would you do this? You would go to your journal entry. You would first enter accounts receivable, and then add the amount of the retainer that you have in that debit column. You would add a description and a name to the journal entry because it's necessary to assign a customer when using accounts receivable in the journal. You may want to set up a customer called AR adjustment. The offset of the retainer in the next line would be unearned income. That's a balance sheet account, a liability account. And you would assign a customer, or you can assign your AR adjustment, and then you would go save and close. Did I put in there? Oh, I did. Okay, sorry. The journal entry should be reversed at the beginning of the next period, by the way. This is the third and last one, recording unearned income method. You would create a service item for the retainer and then create a credit memo for the amount of the retainer you want to apply to each invoice. If the client wants to show their customer how much the retainer was applied to work completed and how much is still unused, they can create a statement for the customer. So first you're going to create a new liability account. So you're going to go to your chart of accounts, select new. It would be an other current liability for both account type and detail type. And under the name, you would put client retainers. And then you go save and close. So now we have a new account, client retainers. Second, you would create a new service item. So you're going to go to your product and service list. You're going to select new, and you're going to select service. And under the name, you're going to put client retainers. And under the income account, you're going to select client retainers liability account. And then sales tax category is going to be non-taxable. Typically, retainers are not taxable in most states. And then you're going to go save and close. Third, you're going to create a sales receipt to record the retainer received from the customer. So you're going to go to plus sign new, sales receipt. For the product service column, you're going to enter client retainers. Enter 1 as the quantity, and then put the rate for whatever it is. And in the message display on the statement box, enter the reason for the retainer, and then you're going to select save. The fourth step, you're going to create an invoice for the services carried out. So you're going to go to invoice, put in the proper necessary information, and on the message on statement box, that's where you would clarify or enter description, and you're going to select save. Fifth step, you're going to create a credit memo for the amount of the retainer to apply to this invoice. So you're going to create a credit memo, and then make sure the credit memo date is the same date as the invoice. For the product service, you're going to enter client retainers. 1 is the quantity. You know what to put in the rate at that point. And then in the message displayed on statement box, enter a note about the retainer, and then save and close. Now that last transaction decreases the balance in the client retainer liability account. Sixth step, and almost finished, the seventh step. The sixth step, you're going to apply the credit memo to the invoice. To do this, you would select +I new, received payment, and then you enter the customer. Make sure the payment date is the same as the date on the invoice in the credit memo. Note that Qbo automatically checks the credit memo and applies the value of the credit memo against the open invoice. And you're going to go save and close. And the seventh and final step, the client can create, by the way, the invoice now shows the applied retainer and reduce the balance due. Okay. The seventh and last step, the client can create a statement for the customer showing them how much of the retainer has been applied and what was used for and how much of the retainer is left. So for the statement type, you would select balance forward. Typically, statements are not sent out till the end of the month, so enter the statement date, start and end, and make sure only to select the relevant customer from the list of recipients, and then either print or preview, email, whatever you're doing. The statement very clearly shows the path of the transactions. Because a message has been added to each transaction, the customer can clearly see the retainer received and the amount of work done and the amount of the retainer that is applied. All right, now remember we said earlier turning off the automatically applied credits when you're dealing with this. So with the accounts receivable method. So you'll likely notice that the recommendation to turn off accounts applied credit option in the advanced tab in the account setting before carrying out the task described. The automatically applied credit setting can be handy, but if you keep it enabled, Qbo may record the payment to a wrong invoice, especially if your client has several open invoices for a customer. So that is something you might want to turn back on if you don't use those retainers often. Now we'll look at client retainer reports. So you can create a report to track open balances as follows. So you would open up your balance sheet and you would look for your client retainer account, and you would select on top of the balance. You'll see the balance there, you double click it, and then this report will come up, the one we just saw. You could do that with anything on your balance sheet, actually. So you go to balance sheet or any of your statements, you double click on it, and then it'll come up and tell you what, how that number comes about, everything that applies to that balance. So customize the report as follows. Change the date to all dates. Under rows and columns, choose the group customer. Also select change columns and remove any unnecessary columns. Under filter, select clear filter and then choose uncleared in the drop down. This is a test question, so I want you to understand what it's saying here. So in the filter, you're going to select cleared filter and then choose uncleared. Then you'll go to run and save it. And you want to save it as customized so that you can use it at another time. There's one more step to be made to this report to make it effective. At the moment this report shows all retainers, there's might be several with zero balances. So if you've had retainers before and they've been paid off, they're going to still come up. So to get the report to show just retainers that are open, you need to reconcile your client retainers. So you'd go to your accounting on the left-hand navigation and go to your chart of accounts, reconcile your client retainers, make sure your beginning balance is 0, and then your ending balance would be 0. You're going to get rid of everything that's been paid and start recycling. Start reconciling. I'm tired. Select the payee header to sort by payee. Mark any retainers that have been fully used as cleared. All right, one half will show in the payment column and the other half will show in the charge column. With all the fully used client retainers cleared and the difference 0, you would then click Finish Now, and now you should have nothing in your report, none of your clients in the report that have 0, only the ones that have positive balances. So because you customized the client retainer report by adding the filter to uncleared status, you would only show your open retainers. We're coming to the end, guys. You are using an unearned, here's our questions for this particular, so this is our summary page. You are using an unearned income method for tracking client retainers. Which two of these tasks must be done to create a report that displays only outstanding retainers? That's what we just literally looked at. The answer would be reconcile the client retainers account regularly using an ending balance of 0. And the other one is run a report on the client retainer account, grouped by customer and filtered by uncleared. Your client invoices their customers with 7-day terms. They just landed a job where they have decided to ask you a deposit to pay for materials before conducting any work. The job will be completed within a month. They want to know how to report the deposit without reporting income. What process would you suggest to your client? The answer is use the received payment screen to enter the deposit without applying it to an invoice. Here's another question. When a client runs and saves a customized client retainer report and it's 150 pages long, what two situations might have occurred for such a long report? The customized report field is not filtered for cleared, filtered, and then uncleared status, or the client is not set up to date on reconciling their customer deposits liability account. All right, and then that should be retainer. I don't know if I by mistake wrote the wrong thing. There was the second page there. Which statement is true about using deposit feature in QBO? Using the deposit fields on an invoice allows you to make the date of the deposit different from the invoice date. Here's the next question. A client operating on an accrual basis has been using the received payment screen to record payments on account from customers before jobs have been completed and invoices created. At the financial period end, which date should be taken to account for these credit balances within accounts receivable? Remember, I was saying you need to reverse it. So you'd create the journal entry to debit accounts receivable and credit a liability account within the balance sheet. And once saved, the journal entry should be reversed at the beginning of the next period. And the last question, which statement is true about displaying open client retainers? You would create the client retainer report starting with the balance sheet. Remember, you went into the balance sheet and double-clicked on the balance for your client retainers. And our last topic is vendor prepayments and deposits. Clients might need to pay deposits or prepayments to vendors before receiving goods and services, just as we saw retainers from asking customers. This is us on the other end paying our vendors, or our clients paying their vendors. Clients can use the accounts payable or an asset account to track their payments or run reports in QBO. We'll look at both of these options in this lesson. As a pro advisor, you can help your clients record prepayments to vendors correctly. One option is to record the vendor prepayments and post them to accounts payable to decrease the balance. Then apply the balance later when the bill arrives for the goods and services. This step is in the next slide. So first, we'll need to make sure that the automatically applied bill payments is selected in your account settings. This allows the credit to be applied automatically when you check the bill. So now we can post the vendor payments to the accounts payable. You're going to enter the prepayment by creating a check. In the category column, in category details grade, you're going to select accounts payable account. This creates a negative payable. When done, select save and close. This prepayment should apply to the bill when it comes in. When the bill arrives, create a new bill. In the amount column, enter the total amount of the bill and save and close. Now both the prepayment and the bill has been entered. In the unpaid bills report, we can see the negative amount in the prepayment and the positive amount in the bill in full. The amount owing to this vendor is the total or net amount of the two. Now it's time to pay the vendor. So you'd go to +sign new, pay bills, select payment account, check the box of the bill to pay. When you check the bill, the credit will be applied if automatically apply bills was selected in your account settings. Note that QBO fills in the total amount of the credit in the credit applied column and the remainder of the bill in the payment column. Your client can apply all or some of the deposit against the bill. If you're not fully applying the credit, change it to the appropriate amount. If you are applying the credit but not paying the remainder of the bill, clear the payment amount, put what you're paying, and then go save and close. The bill is now marked and paid. Both the prepayment and the bill no longer will appear on the unpaid bills report. Another way to track vendor prepayments is to record them to a vendor prepayment other current asset account, increasing the balance until your client is ready to pay the final bill. Start by creating an other current account to track prepayments made to vendors. So you would go to accounting, chart of accounts, new, and then you would have other current accounts set both for the account and detail type. And then the name of the actual account is going to be vendor prepayments. Then you're going to go save and close. Then you're going to enter your check or expense to the vendor for the prepayment. So you're going to go +sign new. In this case, we'll do check. Populate the form with the payee, bank account, and payment of the prepayment. And then for the category, you're going to select vendor prepayment accounts. Add a note in the description field and then add the amount of the prepayment and save and close. Later, when the total bill arrives, we'll enter it to reflect the amount of the prepayment received. So you're going to go to +sign new, bill, vendor, bill date, due date, and bill number. In the category box, you're going to select vendor prepayment account. And in the amount box, you're going to enter the prepayment as a negative value. You'll add a description. In the items detail, you're going to add items that you purchased, and then you're going to go save and close. You can also record vendor prepayments without altering the bill amount by entering the bill for the whole amount and then entering a vendor credit for the prepayment amount. To do this, use either the other current asset vendor prepayment account or a product service item that maps to that account. When you're ready, apply the credit on the pay bill screen. The advantage of this method is that clients see the total amount of the bill, the vendor credit, and the bill payment when they look at the bill and applied payment report. So you can see each step clearly there. I try to make it as big as possible, but I know when you make it big, it kind of distorts it a bit. Clients can run a report to view any existing prepayments in QBO. The process is similar to the one used with customer retainers. It involves reconciling the account used for the vendor deposits and prepayments, and then use the filter in the report. Before your client can run the report, they need to reconcile the balance sheet account to which they posted the vendor prepayment transactions. When reconciling that account, enter its ending balance as 0, regardless of the actual balance. You should recommend your client reconcile that account at least once a month and clear out any prepayments that have been paid. What if the client makes the vendor prepayment in small installments? If a client has a large amount posted to a vendor prepayment account but pays in small installments, the transaction won't clear until the prepayment is fully paid. The client can then clear the bill against all the installments. To easily track the open vendor prepayment, you can run a transaction detail report for the vendor prepayment account and customize it as follows. So you'd run the report for all dates, group by vendor, filter for cleared status of uncleared, remove any unnecessary columns, retitle the report, and save the customization report. This way it allows you to easily run it again at any time. If you see, we're just following the same exact steps as we did in the other section. This time it's just for vendor prepayments. So here are our questions. What 2 things are involved in creating a report to track deposits by vendor using the other current asset method? The answer is filter for cleared status of uncleared and set dates to all. If a client pays 60% down for products purchased from overseas and it takes over 6 months to arrive, and he was just creating a bill and paying 60% of it, now he's hired you as his bookkeeper, which of the steps would you include in order to run a vendor deposits outstanding report? Well, the step would be to create an other current asset account to track vendor deposits. That would be step number 1. You'd create that other current asset account to track vendor deposits. How should you recommend the prepayment to be recorded? This actually goes to the same problem. How should you recommend a prepayment to be recorded? The answer would be set up a vendor prepayment account and post the initial payment against that account. And would you believe this is our last question? A client has several suppliers they purchase their material from, and most of the suppliers require part or all payments to be made at the time of the order. You advise your client to set up a prepayment account that can be reconciled each month. How should this account be set up? The answer is set up an asset, or we know as other current asset, but set up an asset account called prepayments. So an hour and 45 minutes, holy cow. I'm really hoping section 5 is not this long. Well, I'm hoping to get section 5 up before this weekend, if not by this weekend, and then I'll get into payroll. All right, thanks for listening.